So, welcome to Lesson 4, The Basics of Investing. In this lesson, we'll start out describing what are stocks. And basically, stocks represent our ownership in a company. So, for example, if you own a 1% stake in a company, then you have a 1% ownership in the company's assets and earnings. An example could be Microsoft. And when you own a small part of Microsoft, each year when they increase revenue or grow by selling software, you take part of that growth in respect to the percentage that you own. You as an investor are typically rewarded by either the growth in value of your stock or getting dividends. So how do you as an investor make money from stocks? As already mentioned, you buy at a certain price, you believe in a company, the company behind the stock does well, they increase their earnings, they make good negotiations to enter other markets, they cut costs by negotiating with logistics. Or they just have some technology or a new medical drug or something that is patented, which nobody else can make, and they are able to scale their business and earn money. When that happens, the view on the stock and the expectations of the company increases. And that makes people like you and I, investors, buy the stock, in the belief that the underlying company will continue on doing better. Next year, they will penetrate another market, or they will develop or enhance their current drug, which we think will lead to even more revenue and even more growth. The more people that buy the stock, the more it increases in price. And as an early investor, this means an increase on your stock price, so that's one half of making money on stocks. And the other half is that the company will make dividends yearly, meaning that they pay out money back to the investors and share the company's profits. Then when we talk about stocks, we also have to talk about bonds. These two are typically mentioned together, and where stocks is an investment in a company and a leap of faith in some way, where you believe that the company is worth more than it is today, you pay money for the stock, but you're not guaranteed any return on your investment. Whereas bonds is more like a loan to a company, but you buy a bond, you give money to the company. And in the contract of the bond, it is written that at some point, let's say over a 4-year period, you get coupon interest, meaning that every year you get a specific interest rate paid out to you. And then after exactly 4 years, the initial loan amount that you paid, let's say it was $10,000 up front, you get that returned. This is less risky than stocks, and therefore it also offers small returns, but a stable return nonetheless. Whereas buying a stock, you're not capped to a specific return. But then again, you're not guaranteed anything. And as I mentioned before, you could stand to lose everything, but this is about investing, and it's about investing in stocks. So I'll keep my focus on stocks and leave bonds out for now. In order to talk a little bit more about these pros and cons of investing in stocks, I've made this slide where you can see stocks offer return through compounding gains and dividends. And we'll be talking a little bit more about compounding gains, but this is mostly about that if you were to invest, let's say $1,000 in a stock today, it increases with 10%. So next year it's worth $1,100. Then going into year 2, and let's say, again, we expect an increase of 10%. The increase is now based on the $1,100 instead of the $1,000. And this is called the compound effect. So what more does stocks offer? It is easy to buy, it's easy to sell, meaning that money-wise, it's very liquid. And if you compare this to, for example, your car or your house or your rare Pokemon cards that you want to sell, yes, these are worth something, but you could have, let's say, $10,000 in stocks, and the next day you could sell these and have cash in hand. And this is valuable to have something that can increase in value, but you can also liquidate it and use the money quickly. Whereas, for example, if you want to sell your house or your car or something of value in your home, this could take days, weeks, even months. Also, it offers a protection against inflation. And we'll talk a little bit about this on the next slide. But basically, as you've probably heard before, when you have money sitting in your account with no interest rate on the account itself, so the money that you have deposited, if there's zero interest rate, then as inflation increases of 1 to 2% year over year, it's not that you lose money in your account, but imagine everything outside of your account all increase with 1 to 2% a year. And if your money in that account does not increase with the same interest rate a year, that means that your buying power for that money has decreased. But I'll show that more visibly in the upcoming slides. Stocks also offers the possibility to really dive into a company in your line of work and have a strong conviction in buying into that company. so you can use your knowledge and your expertise to find good companies which you know are doing good business. And since you're in that work area, you know that this company, they have awesome products, or, if they make this big deal, then they will completely wipe out all competition. Then you, as the investor, you get to really dive deep into this company and make it so that this knowledge that you have, since you have worked in this area or you're just interested in this area in particular, you get to translate that into making good investments. But then, of course, on the other hand, when you have pros, you also have cons. First risks are these typical pitfalls. You'll have new investors, and I've done this myself. You're chasing the hottest new stock that all your friends are talking about or someone at work is talking about, and you just dive head into the stock and not really thinking much. This can be profitable in some situations, but in the majority of situations, you'll see that people are just buying into this stock as a hype. And when you really take a look into the fundamentals of the company, there's not really any substantial proof or evidence that they should be worth this much. And again, this has to do a lot about the human psychology, where we don't want to be left out. We have FOMO, fear of missing out, and instead of thinking, we just act. The second pitfall is that typically the new investor would try to time the market, which translates to that when we see a stock which we have been observing and wanted to buy, we see that taking a dip and we are looking for a time to enter. Sometimes we simply wait too long. And let's say we wanted to invest $1,000 instead of buying 100 this week, 100 the next week, and so on. This is dollar cost averaging. Instead of dividing our investments over time, we sit there, we wait for it to drop, and we're waiting on, okay, it can go even further. And then the next morning, it shot up 10%, 15%, whatever. And vice versa, we see a stock increasing, but we're still waiting a little bit for conviction from the market, and then we see a big increase the next day. We're still waiting a little bit, and an even bigger increase the day after. We're better left off with the first method of just investing a little bit into the stock and kind of spreading out our risk and increasing the likelihood that we will catch these increases. Of course, this has to be weighed up against these transaction fees, so you have to pay every time you buy a stock. But one could argue that it's better to pay a little bit more transaction fees to make sure that you get a more decent entry when you invest in the first place. Third pitfall, and probably the most important, is that new investors invest in stocks without understanding the business. And this ties to the first pitfall of chasing the hot stock, but it also has to do with new investors investing in stocks simply underestimates the time that you have to put in on following up on your investments and looking into the markets of the companies which you have invested in order to be successful. Yes, of course you can buy off these blue chip companies such as Microsoft, Apple, Coca-Cola, and that's a completely plausible way to invest. And that's how I invest myself, as I do not have the time and effort to put into analyzing and reading up on all these different reports and market updates and so on. But if you're sitting out there and you want to find the next hidden gem, you have to spend the time and effort to learn about the companies, to learn about what makes this company special in the market. Why do you think they have longevity? What is it that makes them special? And from all that data and knowledge, then you can have conviction and start investing. Then on to risks, you have market crashes and you have all the external events which are out of your control. So you could have strong conviction in this new company. They're doing great. They have a new CEO.